What's up, everyone, and welcome to the Long Game Podcast hosted by Thomas Kopelman and Jacob Turner. In each episode, you'll hear us break down financial topics that are relevant to you and your situation. Our goal is to help bring credible financial information to you in short, bite-sized episodes.
All opinions expressed on this show are for educational, informational, and entertainment purposes only. Nothing on the Long Game Podcast should be considered advice. Always consult with your team of professionals before making any decisions regarding your finances.
All right, welcome back, everyone, to another episode of the Long Game Podcast. Today, we are joined by a special guest, Paula Pant. She hosts the Afford Anything podcast, which has over 30 million downloads. She was also a part of a Netflix show, Get Smart with Money. She's a Columbia grad. Honestly, just a big content creator, which is really how we got connected. I got to do a YouTube video with her and really dive into things. But Paula, we're really excited to have you here and just chat and all things personal finance, which is really your bread and butter.
Absolutely. Thank you so much for having me on. I'm excited to be here.
Yeah, us too. So we haven't done an episode like this in a while where we really talk about what's going on in the world, what's going on in the economy. And so that's going to be the topic of today. I will take a step back and say a lot of good management and personal finance is actually like avoiding some of the things that's going on in the world, right? Like I think being way too focused on interest rates and elections and all of these things can drive poor investment decisions, which are really, if you're worried about what's going to happen in the next 1 to 2 years, your investments are probably not aligned with what you want, right? Like if a 30% market drop is going to hurt you on a purchase for next year, well, maybe we shouldn't be investing those dollars. But I still think talking about interest rates do make really big impacts on decisions you make about moving and home buying and financing and just all of those type of things. So I always like to start that way because I think a lot of the Twitter people from around the world make so many decisions based on the current economy, and all it does is drive them to make bad decisions.
Right. So there are a couple of elements, and I'm glad that you said that, because certainly when it comes to investing, the long game is what matters, right? And so we invest for the long term. We a good investing strategy is one that can withstand market volatility and is suited for the long game. But just as you said, when it comes to should I sell my home, or, I got a new job opportunity out of state. Should I sell my home or should I hold on to it and rent it out for another couple of years, even if that means that I have to go be a renter out of state when I move, right? That's a type of immediate decision that a person has to make the moment that they get that job opportunity out of state. Similarly, the transmission on my car just blew out. Should I finance a new car, or should I see if I can hold on to this one for like another year or two, right? That's a decision that's partially, at least, partially it's going to be impacted by the condition of your car and your how essential a car is in your day-to-day life. Do you need it to go to work, etc.? But it's also sort of going to rely on understanding what's happening with interest rates and understanding what's happening more broadly in the economy. And then finally, there's the behavioral component, right? Like we know that eating vegetables and exercising is good for us, but there's always the behavioral element of what's going to motivate us to do that. And similarly, in the world of finance, we know that playing the long game when it comes to our investments and not trying to time the market makes the most sense. And there was study after study shows that, statistically speaking, a buy and hold strategy is superior to any type of attempted market timing. But it's so tempting to think this time it's different. And so sometimes having a solid understanding of what is happening in the world around us can, rather than use that as a reason to embrace market timing, it can actually be a reason to further lean into having a long-term view.
Totally. I love the first half of all the things that you were talking about here of like, do I move? Do I keep the rental? Do I buy the car? Because I think a lot of people fail to realize that financial planning is really making all of these decisions and making the right decisions for you at the end of the day. And that current markets change, right? So like we have all of these things that we learned from our parents of like never take on any debt, right? You always pay cash from cars, you always do X, Y, and Z, right? And that's because of the basically the world they went through at that time, right? When they were our age, debt was really, really expensive. It was very similar today, maybe slightly higher, right? So they basically built all of these decisions on that. They based all their decisions on that. And then today we have people who are like, man, we had a 2% mortgage and we had a 2% car. But we have these things put in our mind that we have to make decisions based on what was told to us. When in reality, a lot of financial planning decisions actually do change based on the current economy we're in. Like for me, I'm totally fine with people financing a car. Right now, a little bit less so, right? The last couple of years, if you can get a car loan at 1%, 2%, maybe even 3%, I'd much rather leave my investments for 50 years, right? But you're borrowing at 12%, then it starts to become, maybe I buy less car, maybe I buy a car in cash. But these decisions really do change as the environment changes. But let's have you respond to that if you want to, but update us on what's going on in the economy.
Sure. Well, so the Fed meets the Fed meets 8 times per year, which is on average once every 6.5 weeks. And so at the most recent Fed meeting, prior to the date that this episode is going to air, at the most recent Fed meeting, they decided to hold interest rates steady, which was widely what everyone was expecting. But Jerome Powell, the Fed chair, put out a statement in which he said that the Fed is concerned about the slowdown of progress when it comes to the decrease in inflation. So inflation, based on March numbers, the 12-month average up through March, inflation is currently at 3.5%. And the Fed's target rate is 2%. Now, the good news is inflation has reduced significantly in the last year, but the bad news, as Jerome Powell's statement said, is that slowdown has really decreased significantly. The April jobs report recently came out, and it showed a growth of 175,000 new jobs. That is significantly less than the 241,000 new jobs that analysts were expecting. Now, overall, big picture, we still have a booming jobs market, right? Unemployment in April ticked up from 3.8% to 3.9%. So unemployment, historically speaking, is at a near 70-year low. April's jobs report was the 40th consecutive month of job gains. And it was the 27th consecutive month in which unemployment stayed below 4%. So in the big picture, we have record low unemployment / record high employment, right? It's still sitting pretty, but we're only now, with the slowdown in jobs that was reflected in the April report, we're only now beginning to see the first little step of some cooling of the economy. And until the economy cools a little bit further, it's likely that inflation may stay around where it is, which is currently at 3.5%. Inflation may stay around there for until we see more evidence of cooling. And so, given all of that, there is, at least what a lot of analysts are talking about right now, sufficient reason to believe that the Fed is going to keep interest rates where they are for possibly the next several cycles. Now, the reason that that's significant is because if you look back on like what people were talking about in January, almost everybody thought that the Fed was going to start reducing interest rates around now. People were having debates on, is it going to be Q2 or Q3? And so back in January, that was the chatter. Nobody is talking about that anymore. Now that the debate isn't, is it going to be Q2 or Q3? Now the debate is it going to be Q4 or are we talking 2025? Yeah. So, yeah.
I totally faced this. I bought a place. I moved in February, and like I was just waiting and waiting. Like I wasn't going to close on anything, and we basically ended up at 0.7% higher in the last week, right before it closed, which was not very fun. But I think as we look into this year, I think this is why. I mean, we still see mortgage applications are at all-time lows, pretty much. Like people aren't really moving in houses as much, but at least in my life, I've seen that start to change in this last month. Like, we live in a brand new community. Things were sitting open, and then everything sold. And I know time, like weather changes are one thing, but I think people are starting to realize that like this rate drop that we're hoping happens might not happen. And we can't sit here for a couple years before we make decisions. And a lot of times when people are making decisions on cars, houses, etc., they're really they're looking at it from an interest rate side of things versus looking at an affordability side of things. So that's where I try to talk to people and say, like, let's look at what the world looks like today. What can you afford? Is that what you want? If so, let's go make the decision. And if interest rates drop, that's a really great opportunity for you. And if they don't, at least you know that you bought what was affordable. But I think there's still this side of the world where people just assume that rates are for sure going to come down. And if I was going to bet on it, I would say in all likelihood, rates aren't going to hover around 7 to 8% for 10 more years or 15 or 20 more years. But is it possible? It is, right? If we look back in history, this is a pretty average interest rate environment that we're in. But because everybody lived through the 2020 period of time, everybody thinks we're at historic highs when we're really at historic averages.
Right.
So,
exactly.
do you really want to sit and wait for 4 more years for rates to potentially drop? I mean,
Right.
I probably wouldn't if you could afford it.
Right, right. Yeah, if you look at what mortgage interest rates were back in the early 1980s, they were double digit, significant double digits. So it's absolutely true that rates are currently at historic norms. What's interesting about this particular era is that because we had the ZIRP era, the zero interest rate policy era, in the 20 teens, right, coming out of the Great Recession through the pandemic during that 11-year bull run, we now have a situation that is historically unusual. And that situation is that 70% of mortgaged homeowners have an interest rate that is 3 percentage points or more lower than the prevailing interest rate.
I saw you post that.
Yeah.
I was pretty amazed by that.
Yeah. Now, there are a couple of asterisks in there. So, first of all, that is a reference only to homeowners who have mortgages. Right now, there are a significant number of predominantly baby boomers, but baby boomers are a huge subset of the population, right? There's a huge subset of homeowners who do not have mortgages. They're 65 years old. They've paid off year 29, year 30. They're done. And so non-mortgaged homeowners no longer have that golden handcuff scenario. But among the homeowners who do, and I don't remember the exact percentage off the top of my head, but it's over 60% of homeowners do have mortgages. And of the 60+% of homeowners who have mortgages, 70% of them have a mortgage rate that's 3 percentage points or more lower than the prevailing rate. And what that does is it creates, like I said, the golden handcuff scenario, right? It's a lock-in effect in which mortgaged homeowners are highly disincentivized against selling their home because they would have to trade in a substantially lower rate for a higher rate if they were to get out a mortgage on a second home. And so, some of the advice that we often give to retirees, oh, you could save money by downsizing. That often doesn't apply anymore. You can't save money by downsizing, depending on what price points you're talking about, because the new rate that you would be paying would offset the cost savings of a home that you downsize into. And so it creates this lack of mobility in our society.
Yeah.
And it creates a situation in which a lot of existing mortgaged homeowners feel stuck because they feel unable to move. And meanwhile, renters also feel stuck because they face this trifecta of higher housing prices, higher interest rates, and low inventory.
And their rent is probably a lot cheaper than it's going to be to cost to buy and move into somewhere else. Like, I think there's a lot of people in the world that can't comprehend that like renting is cheaper than buying. Like, and it's a reality, right? Like, if I'm a property manager, I've owned this place for 20 years. I'm not all of a sudden like, oh, interest rates doubled, I'm going to go from $2,000 to $3,600 a month on this rent. Like, they're keeping things steady. They're keeping renters there. Like, it is a reality in a large amount of cities that renting is cheaper. And I was I was working on a client today and I was looking, and they have like a $1 million mortgage, and it's less on a monthly basis than my $550,000 mortgage is. And I was just sat there. I was like, gosh, that just kind of sucks to look at. Like, I've half the value of a house, but my monthly payment is the exact same. And you're right. Like, that is totally a golden handcuff for a lot of people to understand that, like, I don't know if I can really move because the upgrade isn't doable, which is why we see a lot more housing projects and things along those lines happening, because the moving is hard. And so we see also a lot of people who had adjustable rate mortgages, or people who had 15-year mortgages, and they're realizing like, oh, I need to make a change, but there really isn't a good option to make any changes.
Mm-hmm. Right, exactly. But it's absolutely true that particularly in high cost of living areas, um, the price to rent ratio is skewed in favor of the renter. And so especially if you live in a high cost city like New York or Boston or Los Angeles, it very likely makes more sense to rent.
Totally.
Well, and I think to your point, Paula, I think one thing to think about too, given interest rates, we talked about how we don't want to time the market when it comes to investing, but I do think there's a lot that can be done with planning, like you mentioned, Thomas. And when we think about having cash, right, if we're not buying, we're not having this big down payment and we're renting, even outside of the numbers, if you can have an extra $1 million in cash that would have gone into your house, that's now earning essentially 5% risk free, it's a huge benefit for you.
Mm-hmm. Right.
Yeah, I mean, I just think it's such an interesting time right now to think about the planning and how you handle this, because is it a good opportunity? Is it a good time to buy? I don't really know, right? Because everybody says no, but then as interest rates drop, are home prices just going to accelerate even more, where you kind of end up at this break even, where, like, I think the way that I'm advising a lot of my clients is buy if you can afford to buy today, because then if the rates do drop, this becomes an even better thing for you than if you wait. And now that pushes home prices to go up, which in all likelihood it probably would. Then you're actually not in a better situation by waiting.
Right. Well, so the situation that we're in now, so if you think from the point of view of somebody who currently has a mortgage that they have locked in at a low interest rate, right? Somebody who currently has a 3% interest rate mortgage, they now can arbitrage between the cost of their mortgage and the yield that they get on a savings account. Let's think about how wild that is, right? When your risk-free return on a savings account, a high yield savings account, is several percentage points higher than your mortgage, your fixed rate mortgage. That's the situation that many existing homeowners find themselves in right now. And what is likely to happen is that as interest rates decline, as that lock in effect starts to diminish, more of those homeowners who are seeking, some percentage of whom are seeking mobility, are going to start listing their homes on the market. So the volume of transactions, which last year declined by 38%, is likely going to uptick again. That's going to be good news for real estate agents and brokers, because they've seen a lot of their business dwindle. That industry has. And so it is true, or I mean, I shouldn't say it's true, but it is likely that we will see more existing homes come onto the market as interest rates drop. But that's also likely to be the time when we see more buyers come onto the market as well. And if you think back to the year 2020, right? Think back to during the pandemic, how difficult it was at that time for people who wanted to buy homes to buy a home, because when homes came onto the market, often homes would get multiple offers on the day above asking price on the day that it was listed. And that was simply because the supply demand imbalance was just tilted so asymmetrically, right? And due to the lack of new construction inventory that is in the works, right? It's, I think, reasonably likely that when interest rates decline and activity starts to increase, yes, some new homes will come onto the market, but in most major markets, that's unlikely to be enough new inventory to be able to meet all of the increased demand. And that's basically just a kind of a wonky way of saying, if you're waiting for interest rate as a buyer, if you're waiting for interest rates to drop, so is everybody else. And if you decide to go in at the same time that everybody else does, guess what's going to happen?
Back to mania like the last time.
Right. It's
But
going to be 2020.
I think the risk-free rate side of things is really interesting too, because obviously there's the behavioral side of like paying off a mortgage and, you know, just not having to think about it. Like we can all attest that no mortgage payment, your monthly costs are pretty low. That's going to feel pretty good. But I think the other side of it too is like when you can get a yield on cash of 5.1% and you have a 2.5% mortgage, like even after taxes, that is a better decision and it gives you liquidity, right? Like I
Right.
totally, you can get a home equity line of credit. I'm a fan of home equity lines of credit is like your backup reserve. Like if you ever need it, my goal is that you never do need it, but it is something that can be tapped into on the occasion of worst case scenario, you dip into your emergency fund. But in all reality, like borrowing from the liquidity is very different than having true liquidity in a savings account and being able to use those funds. But this argument's also kind of funny to me because I see like 35-year-olds or 40-year-olds be like, yeah, I could pay off the last few $100,000 of my mortgage, but instead I'm going to hold in a savings account. It's like, why are you holding that amount of money in a savings account anyways? That's just telling me that you don't have a use case, you don't have a plan, you don't know the right place to put your dollars if you're sitting on hundreds of thousands of dollars in a high yield savings account, even with a good rate.
Well, I don't know. I mean, if I were somebody who wanted to pay off my home, and I had a $300,000 balance on my mortgage, but I think in that case, keeping $300,000 in a high yield savings account where you are arbitraging and you are getting that risk free return, it provides you with that arbitrage, it provides you with that return, and then that money is available with no risk, such that when that return is no longer there, when that yield on that savings account is no longer there, you can immediately move that money into paying off your mortgage.
Well,
And
at
I
that
think
point, wouldn't you rather lock in longer term bonds with a higher yield?
not necessarily. So I think that I have 7 homes, all of which I've paid off free and clear. So I paid off all of my homes when I was in my 30s. And the reason that I did that is because I think there's a distinction between somebody who has a W 2 job who collects a steady paycheck versus somebody who is an entrepreneur who has a lot of income volatility. And if I were a tenured professor, I never would have done that because I would have had
I love that.
enormous job security.
Yeah.
Right. But as somebody whose income could theoretically fall to zero, what I want to do is create a very conservative, defense first set of like source of income through rental properties. And by virtue of doing so, I then have a bigger cushion that I can use and greater security that I can use so that I can take greater risk in my career, or in the business that I run as my day to day work. And so I think that the choice of
That makes sense.
career that a person has, the choice of their primary income, has a lot to do with it. If I were, for the people out there, if you're 35 and you're a musician, a full-time musician going gig to gig to gig, there's so much volatility in that. And you might have some very lucrative years, but you might have some 2020s in there as well, right? And if that's a profession that you're committed to staying in, then it absolutely makes sense that you would want the security of having a paid off home so that you can pursue music as your full-time gig.
That's such an important point because so I think we're all shaped by the experiences that we have with money. And my experience with money as an athlete is much like that, Paula, where for a while the income can be really high, but you're always looking around the horizon saying this could go to zero at any moment. And it's led me to have a very similar stance on it where I'm saying I would rather just take the safe route, even though I can sit there and look at the numbers all day and say, well, I could arbitrage this opportunity or I could invest in something that could have a higher rate of return. It's just shaped the way that I view it and saying I'd rather just take the safety net and then take more risk in a potential career opportunity in the future. Yeah. Versus if I knew, much to your point, the 10-year professor is a great example. If you have this really steady W-2 income job, and I think it just comes back to what is the cash flow that is going to be there in your life, and then determining if you're really confident with whatever that cash flow is, maybe you don't pay off the house and you just keep paying the mortgage payments. But if you're not as confident with where the cash flow is going to be in a given year, there is a ton of peace of mind in paying off a house. I mean, I paid off my house at under 3% mortgage, and I felt really good about it. But
Yeah.
that was a personal decision, not a math decision.
Yeah, same. I paid off my primary residence had I think the mortgage was 3 point something. And I do not for a moment regret paying that off. And it's exactly as you said, it's so that I can take bigger risks in my career.
Well, I think there's a couple things I want to hit on there. I think one of them is like the specificity that you had, right? Like there is so many levels of an entrepreneur, right? Like I look at myself and my business and like I have repeatable revenue of a large amount of clients. I can pay myself a lot of money. I don't have any risk of like I would have to lose over half of my clients for me to not be paid well more than enough to afford my mortgage and everything else. There's another entrepreneur who has a lot of risk with a few clients. Maybe it's a lot in sales. And those are things that can change, year to year. And so I think when you look at a different level of a business owner, how their business is made, whether the revenue is repeatable, totally changes the outlook
Yeah.
on this type of decision. And the other side of it too is somebody could say, hey, I'm going to hold no bonds in my portfolio because I know my bonds are for stability. They're for, and instead I take that part out and I use that to pay off a mortgage because it can honestly operate in a very similar way, especially when you have 4, 5, 6, 7%, interest rates. Like that actually might serve as a better bond, so
Right.
to say. So
Yeah.
I love the way that you're talking about that and thinking about it. And then the other thing people forget too is right now you could pay cash for a house, you could pay it off at 7%, and we could go to a 0% interest rate environment again. You say, great, I'll grab a 2% mortgage and I'll take that cash and deploy it elsewhere because I'm taking advantage of the opportunity. Will a lot of people do that? I don't know. Maybe not. But I think people forget that you can do that.
Right. Exactly. You can always, the option is always there to borrow against any property that you hold equity in.
Yeah, exactly. So what else do we need to hit on current state of the economy and maybe some ways to think about that through planning? Is there anything else that you can think about? I think interest rates is a really good.
Yeah, one thing that I think is really interesting is the delta between economic sentiment and economic data. So what we know right now is that unemployment is at a record low. So it's at a near 70-year low. It's been consistently under 4% for years, for 27 months. And wage growth over the last year, wage growth has actually outpaced inflation. Wage growth, as measured by average hourly wages, has outpaced inflation. It was 3.5% inflation last year and 4.1% wage growth. So people are making more money on average. People are making more money in real dollars, and yet, despite of all of this very positive economic data. Oh, and I haven't even mentioned the stock market, which is gangbuster. Like the S&P 500 grew 23% last year.
Yeah,
and
we're up 9% on the year, and in the
last
year we're up about 25%.
Exactly. So, I haven't even mentioned the stock market, but that's also doing really well. And I say that in the context of right now, more Americans participate in the stock market than at any other point in history. So not only are more people participating in the stock market, but also the stock market is doing really well, which means more and more everyday Americans are getting some share of those market returns. And yet, in spite of all of this like very positive data, if you poll the average person and ask them how they're feeling about the economy, people feel glum. And we see this in Gallup polls. We see this, the University of Michigan has this great survey. It's called the Consumer Sentiment Index. And we see this in the University of Michigan Consumer Sentiment Index. People feel really low about the economy, and they've been really consistent and persistent about feeling low for a while now, for many months. And so I think that's, again, it's an interesting, there have been moments in history where people have been irrationally exuberant, where the market has risen and jobs are strong and people are excited, and and that's not what's happening now. Now the market jobs are abundant, the market is strong, and people are really, really glum and depressed. So that, of course, leads to the question of why. And there are a lot of, I guess, armchair theories around why. The most common one that I hear is uh, the sticker shock that comes with inflation is just a lot for people to wrap their heads around. And so even if wage growth surpassed inflation over the last year, that doesn't make up for the fact that that didn't happen the year prior.
Yeah.
So people are still and plus there's just the psychological sticker shock of you're used to seeing a burger cost X, and now that same burger costs Y, and that price anchoring can sometimes just take a while to normalize. So those are the most common explanations that I hear. But I would actually add an additional explanation to that, and this is one that I don't often hear talked about. My hypothesis around this is that it is that lack of mobility, where existing homeowners feel like they lack mobility because they feel the lock-in effect, whereas renters also feel stuck because they have that trifecta of high home prices, high interest rates, low inventory. And so, whether you're a renter or you're a mortgaged homeowner, one way or the other, you feel stuck. And I think generally, when people feel stuck, they start to feel down. So, I would postulate that as an additional reason why there's such a disparity right now between popular sentiment and actual data.
Yeah, I definitely see that too. And it's funny, going back to the markets, right, and where the markets are at and what everybody expected in January of 2023. Like, I remember reading like all of these different predictions, and everywhere said negative market this year. Like, we expect
Mm.
the S&P 500 to be down 20% by year end. And I've met with plenty of clients who in this year came on and they were like in cash, right? They have so much cash on hand because they're like, oh my gosh, whether we moved out in 2020 or whether we moved out in 2023 when we thought markets were going to be bad. And then you look now and you're like, you might have had millions more dollars right now if you never made that change, right? And you said this early on, like, this time's different. I'm sure you feel the same way. Every time I talk to somebody, this time is different, right? COVID was
Yep.
different. 2023 is different. Now we have high interest rates. That's different. Everybody is always thinking that this time is different. And Morgan Housel has all the great quotes about it that, like, every time is slightly different. But at the end of the day, like, there's never going to be the exact same reason for a recession, but it's a human behavior thing, right? We go through these ups and downs. That's part of it. And we have all these people that, like, oh my gosh, they move out and then you never know when to move back in. And just the market timing side of things is just so hard because there's a reason every year why the market's going to go down. There's a reason every year where it's too high to invest in, and then don't invest now. It's going to keep going down from where it's at. And it's a hard game to play.
Right, right, exactly. The this time it's different. There's always a way to rationalize that, but what we know is that, what we know is that historically in the U.S. the market just over the long term keeps rising, right? And it can be easy to talk yourself into thinking otherwise in those moments of fear, but often there's a distinction between um, being rational and rationalizing, and sometimes it's hard to know which one is happening.
Yeah, that's a really good point and a really great way to wrap up this episode. Paula, we really appreciate you coming on. Let everybody know best places to follow you, as well as, like, I know you have a real estate course that is coming available for one of the 2 times per year, right around the week that this drops.
Right. Yeah. So we have a course on rental property investing. It's aimed at beginners. So if you have never invested in a rental property before and you want to get that first rental property, this course is for you. We only offer it twice a year. We offer it once in the spring, once in the fall. And right now, May 22nd through May 31st, this is the enrollment window. So if you are interested in learning about that course, go to affordanything.com/enroll. We have a ton of information about that course there. It's a 10-week long course, very high touch, white glove. We have TAs, we have study halls, we have a very vibrant community. It's a cohort based course. You can take it on demand, but you can also have the accountability of a peer group. And we really walk you A through Z, packaged for you, every single thing that you need to know to get started as a rental property investor.
Okay, perfect. Well, Paula, we appreciate the time and sharing all the knowledge that you have. And everybody, we thank you for listening. We would love if you'd take a moment to please rate and subscribe to this podcast. We put a lot of time and effort into this, and we love doing it. But everybody, thank you for listening, and we will see you back next week.